Let's talk about one of the most important numbers in your financial life, your credit score. Yeah, I know it can feel like this big, mysterious thing, but I promise you, it's not. I mean, think about it. This one little number, usually somewhere between 300 and 850, has a say in almost everything, from the interest rate on your mortgage to whether you can even get a new phone. But what is actually powering that number? What's going on under the hood? Well, here's the big secret. There is no secret. It's not magic. It's just math. It's a formula with very specific rules. And right now, we're going to crack that code together so you can start taking control. Let's do this. Okay, first things first, we're going to focus on the FICO score. Why? Because it's the one that over 90% of top lenders use. If you understand FICO, you understand the game. So here it is, the whole recipe. Your score is based on these 5 things. But look closely, they're definitely not all created equal. Check out the 2 biggest slices of this pie, payment history and amounts owed. Together, that's 65% of your entire score. So let's start right there. So this is it, the single most important thing you can do. Your track record of paying your bills on time, every single time, is absolutely king. Just one late payment can ding your score, and that mistake can hang around on your report for up to 7 years. Consistency is everything. All right, that second huge piece of the pie is amounts owed. And for this one, there's a magic number I want you to burn into your brain. Less than 30%. This is your target for something called credit utilization. So what is this credit utilization thing? It's actually really simple. It's just how much you owe on your credit cards divided by your total credit limit. If that number gets too high, and anything over 30% is seen as a red flag, lenders start to think you might be in over your head. Keeping it low shows you're in control. And the rest of the score? It's these last 3 pieces. You've got length of history. Basically, the older your accounts, the better. Then there's credit mix. Lenders like to see you can handle different types of credit, like cards and loans. And finally, new credit. Opening a bunch of new accounts all at once can make you look risky. Together, these 3 make up that final 35%. Okay, now that you know the formula, let's bust some major myths. Because honestly, a lot of people accidentally hurt their scores just by believing the wrong thing. This has to be the biggest one out there. You've probably heard it, right? People are literally afraid to look at their own score because they think just the act of checking it will drop the number. So is it true? Not a chance. Here's what you need to know. When you check your score, it's called a soft inquiry. It has 0, and I mean 0 impact on your score. A hard inquiry is when a lender pulls your credit because you're applying for something. That can cause a tiny temporary dip. So please, check your score. Check it every week if you want. All right, myth number 2. This one sounds so logical. You paid off a card, you don't really use it anymore, might as well close the account and tidy things up, right? Wrong. Oh man, this is one of the worst things you can do for your score. It hits you with a double whammy. First, you lose that card's credit limit, which means your utilization ratio on your other cards immediately jumps up. Not good. Second, you eventually lose the age of that account, which hurts your length of history. The best move? Keep those old no-fee cards open. Maybe buy a pack of gum with them once a year just to keep them active. Okay, so we've busted the myths, you know the formula. Now for the fun stuff. Let's get into a couple of next-level strategies to really optimize that score. You know when you're shopping for a big loan, like for a car or a house? Well, the scoring models are actually smart enough to know you're going to compare rates. They give you a shopping window where they lump all similar inquiries together as just one. But here's the catch. Look at the difference. FICO gives you up to 45 days, but VantageScore only gives you 14. So what's the pro tip here? Easy. To be safe, no matter which score a lender pulls, squeeze all of your loan applications into a 2-week period. That way, all those hard inquiries will only count as one single hit. It's a game changer. Now this is a powerful strategy, especially if you have a thin credit file or you're just starting out. If you can get a trusted family member to add you as an authorized user to their old, well-managed credit card, you basically get to piggyback on their good history. Their card's long history and low utilization can show up on your report and give you a really nice boost. Just make sure they're responsible and double-check that their bank actually reports this stuff. And finally, let's quickly cover what isn't in your score, because honestly, knowing this can clear up so much confusion. Take a look at this list. You might be surprised. Your income? Nope. How much you've got stashed in your savings account? Not in the formula. Your job? Also not in there.
Now, to be clear, a lender is absolutely going to ask for your income when you apply for a loan. They need to know you can pay it back. But that information doesn't go into calculating your actual FICO score. The score is only about how you've handled debt. That's it.
And that's really what this all boils down to. Once you pull back the curtain and see the formula, those 5 simple factors, you realize your credit score isn't some random scary number. It's just a reflection of your financial habits. And the best part, it's something you have complete control over. So I'll leave you with this. Now that you know the rules of the game, what's the first move you're going to make? What's one thing you can do this week to start mastering your score? Thanks for tuning in.